How's it, guys? Welcome back to FX Rhapsody. Today I just want to show you, a 350 pip move on the British pound US dollar. It's all got to do with patience, and it's all got to do with just learning your strategy or the way that you trade, and just keep on learning, keep on backtesting, and the more you do it, the more you will see it. Okay, before I show you this, just go visit my website. It's on the bottom left corner here, where there's plenty of video content regarding trading, depending on your trading experience. There's videos or categories where you get started in trading, and there's also some nice strategies and all my previous analysis all categorized in there. So just go visit it. There's also my preferred brokers. Do yourself a favor, go check them out. These guys are brilliant. Okay, so what we did, or what I did in the British pound US dollar, and I'm just gonna show you on the 1 hour time frame. Just zooming out a little bit, you can see there was a big bearish movement in the British pound US dollar this whole week. So basically you see the little turn, or you could see a little turn happening in the market where British pound hit a low and then started moving to the upside. Now with that turn, yes, where do you catch this big move? Not, I would say big move for a lot of you. It's not a big move if you go to swing trading and all that. But if you are an intraday trader, scalper, whatever, this is a relatively nice move in pips, depending on your lot size. So we can see that the pound made a way to the bottom, and everywhere that it makes little structures in the market. I'm just going to highlight a little structure here. You highlight it out, okay, and you draw it to the side. So price came down, and you also have all these little structures here. And with these structures, you get your liquidity, like I've always said, liquidity that's lying on the top there, okay? So just above all that structures in the market, so basically price going, making a lower low, lower high, lower low, lower high, and so forth. Price will always come back and go and dig into that liquidity. It's going to go hunt that liquidity. So you always dot them out, because that is where price is going to be drawn towards. So where do you find your entry? Again, I have made videos about this. Just go back into your charts. So we have got this little area over here where price came down, came up, retested it, came up, went down again, came up again, retested that area again. So for me, that was a strong area. It hasn't been broken yet. Yes, little liquidity was tapped into it, and then price carried on to the downside. So price hit a little low at the bottom here, then started making a move to the upside, creating small little lower highs, lower lows, lower highs, lower lows, and then up again. So where do you catch your entry on this area, or where price makes a turn? So you can see price going up, going down, creating a little structure here again. So basically price not breaking through that area. So I'm just going to highlight that for you. So that's an area that you highlight on the chart. So you can see price coming up, exactly the same as what it did before when it went down from a lower low, lower high, lower low, when it was in a bearish movement, as you can see, bearish market. So price created the same one, going up, coming down, retesting that, and where we expect price to come down or go down again, following the same routine price went, or price did when it went or was in a downtrend. So now we can see price doing exactly the same thing, coming up, hitting that area, coming down, going up again, but not going down even further. Okay, so now this is where structure gets broken. Okay, now where does structure get broken? With this big push of a candle, and that is where the smart money comes in, and it pushes the price up, right? That's a big, very bullish candle in the market. So with that big break in the market, just going to take this out, just highlighting, with that big break in the market, there's a gap that's formed here, an imbalance in the market. Okay, and with that imbalance, it's from this candles to that candle, from that wick to that wick. So it's the high of that bearish candle to the low of that bullish candle. It's where the price went its highest and the price went its lowest on those two candles. That's the gap. So price didn't fill that imbalance in the market. And we always want price to come back and fill that area. So price going up and then eventually coming down to fill that gap. It actually did it twice, okay, as you can see. So it was a big imbalance in the market. So this is where you place your entry, okay? So price going up, going down, retracing back into the imbalance. Please guys, go back in your charts and you can see that happening all the time. And that is where you would place your entry, right? So you place your entry, where's my long position? So in that area, oops, you place your entry, you have your stop in place, and depending on your risk, where you want it, I mean, this is an hourly time frame, so this is more of a little bit of a, I'm going to say swing trade, but it's a long trade. So a lot of guys place their stop losses just below that big push in the market. Okay, I like to just leave a little bit of a buffer there, because you can see candles. If you had to place your trade just right on that area, you would have seen price being tapped. Okay, and if you did, it's fine, you could have waited and then price would have come down again. So just below that. Okay, I'm just going to zoom in just to show you. So you have this candle over here. That's your candle that breaks your structure. The low of that candle is going to be there. Okay, I'm just going to highlight that out for you. That's your low. And you would want your stop loss or your stops just below that low of that candle. And then you will see price going up, coming down. You place your trade, price coming up, and then you get your candles or your price just trying to hunt those stop losses for those guys that's in this trade. And you can see with this candle, with that candle pushing down again into that area, but your stop loss will be just below that area. Okay, and this is where you can see price starting to hike again. So you've got your area over here that you've highlighted before. This was also a structure in the market. You can see price going, retesting that area, coming down, or it tested it, retested it, coming down. So you highlight it, you drag it across, and you wait until you see what price is doing in that area. A lot of people will just, ride the trade out up until that area over there, which is also good. I mean, if you had a trade in, it would have been 100 and odd pips, 130 pips. And then you could also just wait and see what price does when it comes to that, because it's retesting that area again, coming down into that fair value gap again, okay? And then start pushing to the upside. And then with this break in this candle, then you know your trade is safe, because it forms another fair value gap in the market. So you take that out, you create that area over there. So now we want price probably just going to come back into this area again. But if you are in the trade, excuse me, if you are in that long trade, or if you were in that long trade, you could see price going up about 300, and let me just do it to the side so you can see it better. So let's say you entered over here, going up, that's about a 350 pip, 350 odd pip that you could have ride to the top. Now where do you exit? You go to your left and you look for any gaps in the market over here as well. I mean, we have got a slight little gap here. The reason I'm saying it's a gap, because that is where price broke before. You see? Just highlighting this out for you. That was another structure in the market, and that is another push in the market. So price gets drawn to those areas in the market. It gets drawn to those imbalances in the market. And that is why I've been highlighting, or I highlighted out this area. This is a previous structure, as we could see. Okay, let's just mark this out for you. right around there. A previous structure in the market, price going, retesting, retesting, going up, retesting again, going down, breaking that area, and with that push in the or breaking that structure, you know, big bullish candle push, creating that fair value gap. And that is why I'm highlighting it out, because if you are not in a trade, or if you exited a trade, you would want to see price getting drawn into that area, and then if there is any bear or bullish movement, or if price starts making a bullish movement in the market, you could see price drawing into that, and that is where you will catch your next buy. Please guys, go try this out, go back test this. This happens every single day in the market, not just on the hourly time frame, not just on the 4-hour daily. It does it on the 15 minutes, 30 minutes, 15 minutes, 5 minutes, 1 minute. You can drill this down even, like I said, to the 1 minute and trade it exactly like this. This is where you catch your pips, guys. This is where you're going to start making money. Please trade risk, or use your risk. Don't just trade blindly. Like I explained to you with your risk, how you place your stop losses. Place your stop losses, leave it there. If it gets hit, wait for another trade to happen. So guys, that's all from my side. It was a nice little move on the British pound US dollar. Hope some of you guys caught that. Don't forget to hit the like button, subscribe to my channel, hit that notification bell, guys. It's just about weekend time, so there's going to be analysis on currency pairs coming your way, so don't miss out on that. Guys, I hope you had a wonderful and pipful week. Stay safe and happy trading, guys.